Hello and welcome to your Monday Futures Market Outlook for October 25th, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles the market has gone through. We bullishly crossed above there about a year ago, and as it bullishly crossed, we had that summer consolidation. At this juncture, the likely outcome continues to be the fact that this pullback that we saw is going to actually be the grounds under which the market actually targets even highs into next year around the 1300, 1350 level. And in order to get those targets, we'd have to see the market break to a higher high above that 1220 area. But at this juncture, the likelihood of there being a very aggressive market crash into the year end is a diminishing probability. When we take a closer look at that S&P 500 on the daily charts using the E-mini futures contract, this morning in the pre-market during the European session, we had a breakout to a higher high up to about 1190 range on the upside. With this upside breakout, if it's actually sustained, a retest of the previous highs up in the 1200 to 1215 area looks like the likely scenario. But as that rally gets up there, we actually are going to be skeptical about its sustainability up into that zone. If we do get a rally up there, we will be looking for topping formations or distribution or anything else that occurs there. Now, in the bigger picture, we do believe that the market will get above these zones, but probably not without some sort of a good profit-taking cycle off this overhead resistance. So to review our key points, we are now intermediate bullish on the market with short-term risk of profit taking. It looks like the year highs are the target right now and everything remains positive, but there's an increasing probability of a profit-taking cycle that could naturally happen off such a prolonged rally with no profit taking. So as much as we have become intermediate bullish, at this point investors should wait for a profit-taking pullback to commit new money. If you're already invested and you want to trade your way through a market pullback, it's fine, but to commit new money at this level is it's not worthwhile. It's a bad risk reward proposition. It's worth waiting for a market pullback to get that money to work. Next year, I want to take a look at the NASDAQ 100 futures contracts, and we've now tested up into the first target of the 2120 area on the upside. But if the S&P is destined to finish a move to the 1200 to 1220 area on the upside, the NASDAQ's measured moves all line up around the 2160 to 2200 area on the upside. Again, we'll be looking for short-term tops up there. Overall, the NASDAQ probably will break out to a higher high at some point this year above there, but we are anticipating at least a profit-taking cycle to occur off that overhead resistance. Next, I want to take a look at the dollar index futures, and this is actually the critical one to watch because so far the market has taken all of its cues off of the intermarket relationship against the dollar, and as the dollar's been weakening, the market's been rallying. At this juncture, the 76.50 to 77 zone, where we're just above, is actually going to play a critical role. Will we see a market bottom develop in here through double bottoming or even just a key bottom retest down along the zone, even if it temporarily trades down to 76 and then back above? Will be certainly an indication that the market may hit its highs somewhere while the dollar index is doing this. If for whatever reason the dollar index is actually destined to make a move all the way down to the 74, 75 level, that would actually create a short-term, very bullish environment from which the market can actually even make a short-term break to a higher high, and certainly would be bullish for crude oil and gold. If that aggressive selling does ensue, but the dollar index here, be very suspicious of a couple retests of the zone in here and a bottoming formation. Next year, I want to take a look at gold futures, and gold has finally done a little bit of a pullback, creating a flagging formation. This is a critical moment because right now with that dollar index weakening, you can see gold strengthening this morning. We could definitely see gold continue to strengthen if the dollar index continues to weaken. But if gold here attempts a rally and does not make a higher high, just sort of has a key retest even as high as the previous highs, if we have a key retest of those highs while the dollar index hits all of its downside targets, then this will just be a topping formation on gold that will eventually lead to a much bigger profit-taking cycle. So we remain skeptical about the sustainability gold. We think it's an increasing probabilities that we've seen the year high on gold, even though maybe 2011 there could be targets as high as 1,500 or higher on the upside of gold. But for the remainder of this year, we're looking to see whether or not the highs that were put in around this 1380, 1390 end up actually being an important high for the year. Next year, I'm going to take a look at crude oil using that QM contract, and we also saw flagging formation right into the shallow end of the retracement zones at this juncture. With this kind of a flagging pullback, as so long as the dollar index remains weak, we could see crude oil come back for a retest of 84, or even finally make a test of the year highs around that 86, 87 zone. If we see crude get up there, again, we're going to be watching the inverse relationship to the dollar, and if that dollar finishes its moves, then we'll also be looking for a top in crude. Finally, I want to look at the 10-year Treasury notes. And surprisingly, even though we've been consolidating for the last 2 weeks, it's been extremely shallow and almost a little shallow flag style formation, holding above this 126 to 126.5 area. At this juncture, some bigger picture measured moves are all targeting the 128 to 131. So the fact that we haven't seen any very aggressive selling in the 10-year Treasury note may mean that there's still actually going to be one more attempt to finish this move up into that zone. I don't necessarily think the 131 is very realistic for an upside target. There would have to be some sort of a catalyst to drive that. But a rally here to finish a move maybe into the 128, 129 zone could very well happen, considering how shallow this entire pullback has been. All we need is a little bit of a catalyst push for the 10-year Treasury note to make that break for that upside.